Okay, perfect. All right, so again, I want to welcome everyone to the webinar called The Big Beautiful Bill Act, What the New Bill Means for You. Okay, so we have, here is our goal today. Just a few set of instructions. Sierra will be hosting the chat. Sierra, if you guys don't know, she's our marketing manager here, so she handles everything in that whole marketing space, and she's a great team member, and so we just really appreciate her. And she's going to be hosting the chat, meaning she's going to be monitoring the chat. And as you guys are asking questions, she's going to kind of compile those questions, and when we get to the Q&A, she will be asking those questions. Some questions, if they are more personal in nature, then she'll communicate that, and then that's something that we can get together and talk about. If it's more general in nature and we think it would be good for the group, then we'll go ahead and make sure we answer those questions generally. And we had, for those at this point who have come in since I've closed the chat and the participant features, if you can put something in the chat that lets Sierra know that you guys can hear okay, or if you're not hearing okay, let us know. Okay. When everybody is muted from the audio, and everybody is muted in the sense from the video, so everybody's private in that regard. Um, and so again, we'll look forward to the Q&A, and that will be after we have the conversation about the One Big Beautiful Bill Act. Okay, so here's some things about the Big Beautiful Bill Act. First of all, it was written into law July 4th of 2025. And one of the first things that's probably important to recognize is that it's, in some instances, it's retro to January 1st, 2025. And that's typically how tax-related bills work. If it happens during the year, it doesn't start July 4th, and anything prior to that, it's the old law. This is retro to January 1st, 2025 in certain instances. So one of the first things we're going to notice is the new bill extends the current tax rates from the 2017 Tax Cuts and Jobs Acts. What that basically means is that particular tax bill was set to expire in 2025. What this bill did was make those tax provisions permanent. So the tax brackets and things like that they're now made permanent. It's not something that will expire in 2028, 2029. They're permanent. This is something that people are going to experience right away. It extends the standard deduction with an increase. Now, I have a slide, so anytime you see the word later, that means I'm not going to expound on it here because there's a slide that specifically addresses that. So extends the standard deduction with an increase, and we'll talk about that later. It extends the $750,000 mortgage interest deduction, but there's a new provision in the law. The private mortgage insurance, or PMI, that is now going to be tax deductible, but it won't be tax deductible until 2026. What does that basically mean? If in 2026 you buy a home and you can't put the amount down like 20%, you're typically going to enter into what's called private mortgage insurance. And sometimes private mortgage insurance conservatively can be like $150 a month. Starting in 2026, that is now going to be tax deductible. Your mortgage company will report it, and it'll just be part of your mortgage statement. So it's nothing you really have to do other than just realize it's going to be tax deductible starting in 2026. For those who have kids that are less than the age of 17, there used to be a $2,000 child tax credit. There will now be a $2,200 tax credit. So, for example, last year, if you had a son that was 6 years old, you got a $2,000 credit. Now that son is 7 years old, and for 2025, that credit will be $2,200. And that will be for every child. So basically, there's a $200 increase to the tax credit. Lenny, I noticed you raised your hand. I'm assuming Sierra is going to, if there's any questions along the way, put it in the chat, and then we'll make sure we answer that. And if that's just a letting us know that you can hear us, then that's perfect. Thank you. Extends the 20% pass through That's for business owners. It just basically means if you're self-employed and you have profits, and let's say your profits, keep the number simple, is 20,000 bucks. There's a 20% pass-through deduction, which in that case would be $4,000. That was part of the 2017 Tax Cuts and Jobs Act provisions. That will become, that's also permanent as well. What that's probably going to mean is that might be more incentive for people to start their businesses and things like that. This is unique as well. Creates up to $2,000 charitable tax deductions for non-itemizers. This is very interesting. Best way I can describe it is, let's say you're married and your standard deduction is $30,000, but you give to charities and you itemize, but your itemized deductions don't add up to $30,000. We're going to take the $30,000 standard deduction, but then now this new tax law says we can claim up to $1,000 for what's called non-itemizers, for people that take the standard deduction. So if you're single, you're going to get a $1,000 charitable contribution, even if you take the standard deduction. If you're married filing jointly, you will get a $2,000 charitable deduction, even if you take the standard deduction. So I think that's going to really benefit people as well. Okay. Then we also have, it's going to raise the standard deduction by $750 for single or $1,500 for joint. So for example, in 2025, the standard deduction for single is going to be $15,750. The standard deduction for married filing jointly is going to be $31,500. And if you're head of household, meaning you're single but you have kids, that standard deduction is going to be $23,625. That represents a $750 increase for single or head of household, and a $1,500 increase for married filing jointly. Nothing you have to do. I'm fully aware of it. I will reflect that on the taxes. Now, it also, this is what a lot of people who are over the age 65 are really interested in, and we'll talk about that in a couple seconds. It temporarily increased the standard deduction for age 65 and older by $6,000. Now that's huge, and in a couple seconds we'll talk about that. There's also this new thing called the 1,000 pilot child account. And again, we'll talk about that later, but basically that's an account that you can open if you have a newborn between 2025 and 2028. Also, auto loan interests in certain situations are going to be deductible. But again, later I have a slide that kind of goes into detail, but we'll talk about that in a few seconds. Increase the SALT limit. SALT limit is basically, the whole spirit of it is, the limit was $10,000 the last few years. The limit has now increased to $40,000, and that's for stuff like state and local taxes, property taxes. What you can itemize was capped at $10,000. That has now moved up to $40,000. That's going to be attractive for people who have higher property taxes, higher state and local taxes, high income earners. So that's going to allow possibly for more itemized deductions. Okay. Now, this is, a lot of people are hearing about this. Now, there's a lot of gray area in this space, but no tax on tips and overtime. And again, there's a slide specifically for that in a couple seconds. Oh, so here we go. Let's get to it. No tax on tips. Now, one of the first things we want to talk about is that it's temporary. It only applies to those that traditionally receive tips. It's temporary, meaning it's only around from 2025 to 2028. Up to 25,000 or on, excuse me, sorry for the typo, up to 25,000 on reported tips, or up to 25,000 or reported tips, meaning your reported tips could be less than that. It does not apply to non-reported tips. And then it phases out once you reach a modified adjusted gross income of 300,000 joint, 150,000 single or head of household. Now, here's the fine print. It's very important. I just have to read it. The deduction lowers your taxable income, which reduces your federal income tax liability. It does not reduce the Social Security and Medicare payroll taxes you owe on tips. The deduction is temporary and applies to tips earned between January 1st, 2025 and December 31st, 2028, unless Congress extends it after that. It is an above the line deduction, meaning you can claim it even if you take the standard deduction instead of itemizing. But this is very important. For 2025, you will claim the deduction when you file your tax return. For tax years 2026 through 2028, the benefit will be applied to your withholding, so you will see lower taxes in your paycheck, and it won't be reflected on the tax return. Clearly, there's a lot of gray area there because we have payroll departments scrambling. Um, we also have we also have businesses that are trying to figure out a way to categorize more of their employees' income as tips. And then the IRS has to kind of figure out some laws to kind of close any loopholes or unintended consequences when you start saying the first 25,000 of income that's considered tips is not taxable, because clearly we're going to want, I would love now when I charge you guys to say, hey, don't pay me anything, just give me a tip. Clearly that's not the intention of the law, but the IRS is going to have to work through some challenges as we attempt to implement this law. So we'll just keep working through that. Okay, a couple more slides. No tax on overtime. Again, that's temporary as well. And that's from 2025 to 2028. It's up to $12,500 in overtime pay. And it phases out to reach the modified adjusted gross income. Now, there's some things that we need to understand here. It's called the no tax on overtime. You can deduct up to $12,500 of qualified overtime compensation from your federal taxable income. For those who are married filing jointly, this cap increases to $25,000. The deduction only applies to the premium portion of your overtime pay, the extra half of your hourly rate when earning time and a half. So the best way I can pull over there and say is, let's say, for example, you work a job where if your hourly rate, I'm sorry, if you reach more than 40 hours in a given week, hour 41, 42, 43, 44 is paid at time and a half. And let's say your rate is $40 an hour, and then time and a half brings it up to 60 or another 20. And for those 6 hours, you were paid an extra $20. You are not supposed to be taxed now on that additional $20 for those 6 hours. Now, you do not need to itemize deductions. The deduction is retroactive, but here's the tricky part. In 2025, employers are not required to change their withholding methods. For the 2026 tax year, the IRS has drafted new forms that includes fields for reporting the portion of overtime pay eligible for the deduction. So in 2026, employers are going to have to keep track of that. If you want to claim the benefit for 2025, you personally will need to track your qualified overtime earnings. So what that means is if you have earned overtime during any point of 2025, and you want to claim that as no tax, then you have to somehow, some way work with your employer or look at your pay stub and see if you can clearly identify overtime. And then we will be able to write off the overtime that we can determine based on maybe a 2025 end of the year pay stub. The jury's still out on how all of this looks, but as we get closer and closer to tax filing, I think some of that stuff will start to come into focus. A couple more slides. Temporary senior deduction. It allowed for tax years 2025 through 2028. It applies whether the taxpayer itemizes or takes standard deduction. It applies whether taking Social Security or not. Some of the promises as part of the platform was no tax on Social Security. That wasn't necessarily accomplished, but what was accomplished is basically if you are over the age of 65 or 65 and older, you have an extra $6,000 deduction. So if you're married filing jointly, your standard deduction, if you're 65 or older as a married couple, is $31,500. Then if you're 6,500 as if you're 65 or older, then there's an additional $6,000 deduction. If your spouse is 65 or older, there's another $6,000. So it's a total of $12,000 if you are 65 years old or older. So that's basically an extra $12,000 deduction. And so that's probably one of the most powerful aspects of the bill for people over the age of 65. Now there are some phase outs. So if your income is higher than 150,000, you're going to start to reduce that $12,000 benefit, and it's totally wiped out if your income as a single person is more than 175,000 or joint 250,000. And again, if there's questions, please throw them in the chat, and I look forward to in a few minutes getting to the Q&A part. Now, there's also these things called Trump accounts. And again, politics aside, these are accounts for children up to 18 years old. Parent must provide Social Security number to show eligibility to work. Meaning the child that is born has to have a Social Security number. Parent may add up to $5,000 per year. It can be invested in a diversified fund that tracks like U.S. equities, so it can be invested in the stock market with the potential for it to grow. It's no deduction, but it is tax deferred growth, meaning if you contribute, unlike a traditional IRA, where if you contribute to it, it's tax deductible. It's no tax deduction to contribute, but the earnings grows tax deferred. The gains are taxed as ordinary income or a 10% penalty if you don't use it for qualified expenses. Qualified expenses, they really haven't put the language out there for what they are. It'll probably be for school. It'll probably be for maybe private school or things like that. It can't be to take the senior class trip. It can't be to buy your first car at 16. But they haven't quite made it clear what those qualified expenses are. But my guess is going to be for some type of schooling, be it private school, K through 12, college, things like that. The child, it will be 100% the property of the child at age 30. And at age 18, it can turn into either a Roth IRA or traditional IRA. Okay. And it's for children born from January 1st, 2025 to December 31st, 2028. The newborn must be a U.S. citizen with a Social Security number. Now, here's the caveat. If you're attracted to the concept of opening these accounts, those accounts will not be available to open up until July 4th of 2026. And for some of you who realize that I'm also a financial advisor, if that's something that interests you, I can definitely help you with that when that time comes, July 4th, 2026. Okay. Auto loan interest is deductible. It applies only to cars assembled in the US. It's temporary as well, so it's going to be from 2025 to 2028. It applies to those that itemize or take the standard deduction. It's limited to $10,000, so you can write off up to $10,000 of interest, and it's phased out for people that make more money. And I just wanted to spend a few minutes on some important fine print. The vehicle's final assembly must have occurred in the United States. You can check the vehicle ID number to verify, as VIN starting with a 1, 4, or 5 generally indicate U.S. assembly. The vehicle must be for personal use, not for business or commercial purposes. However, the interest on loans for business use vehicles is still deductible under existing tax rules. Most cars, SUVs, pickup trucks, minivans, and motorcycles under 14,000 pounds qualify. RVs, trailers, and campers do not. And you have to take the loan between January 1st, 2025. So if you're hearing that, it's retro. So if any of you guys on this webinar have already bought a car in 2025 and you're paying interest, I will say you can't lease it. You have to buy it. You have to get a loan for it. You can't lease it. Okay. And then, yeah, that's pretty much the fine print there. And then the SALT stuff, it only lasts through 2029, and then it'll go back to 10,000. And again, it just means in the past, state and local taxes, real estate taxes, if you had those things and it happened to be more than $10,000, it was capped at 10. Now the cap is 40,000, which may open up um, more opportunities to write off property taxes for people that may have houses that have high property taxes, or you're high wage earners and you pay a lot of state and local taxes. So that's a benefit from 10,000 to 40,000. Okay, so what we're going to do is I'm going to stop sharing my screen. And then what I'm going to do is, Sierra, if you don't mind, I'm going to ask you to unmute. And
Yes, sir.
then, yay, I'm looking forward, Sierra, to hearing some questions that people have in the chat. And even as the questions are asked, it answered, if that generates another question, then put it in the chat. I will say this. Um, Sierra has been communicating in some instances, if the questions kind of merge together, you may not hear your specific question, but hopefully it was kind of merged with somebody else's question. So Sierra, with that being said, we have a few minutes, so I'm looking forward to some of the questions.
Absolutely, yes, sir. So the first one that I saw, it was regarding the first slide talking about the child tax credit. Someone wanted to know, was it only someone, or was it only a child at 17 or under, or was it only individual kids that were under 17?
Great question. I think if I'm understanding that question, best way I can describe it is, if the child is 15, $2,200. If it's 16, $2,200. The year the child turns 17, they no longer qualify for the $2,200 child tax credit. It is now replaced with a $500 dependent credit. So again, the year the child turns 17, that tax year, we lose the 2,200, and it's replaced with a $500 credit.
Awesome, yes, sir. So let me mark that that was answered.
Thank you.
Going on to another question that was asked. It was asked during the second slide,
Okay.
if there is a way to say that things were donated, even if they were actually not. That's how the question was texted. So,
So I'm going to ask whoever asked that question to maybe try to make it a little bit more clear. Um, so Sierra, just do me a favor. Is it
this,
possible for you to find that and just read it exactly as it was read, or
yeah,
that's what you did?
that's what I did, but I can scroll up to it. Yes, it says, is there a way to say things were donating if they were actually not?
Oh, there, there are ways of saying it, but that's against the rules, so we won't do that. If, and I don't know who asked it, and so short answer is, if I'm understanding that, we kind of ingest, unless you want to clarify that question. If I'm understanding that right, the good news is you can take a charitable contribution, but the fundamental concept is you gave to a charity, and we're talking cash donations. Yeah, we're talking cash donations. So if you give 500 bucks to the United Way, and you gave it by, and when I say cash, I mean check, not cash money. If you gave $500 to the United Way, they typically give you a receipt. And in the past, that $500 was not tax deductible because you took the standard deduction. But in this case, up to $2,000 if you're married, or $1,000 if you're single, could be what's called an above the line tax deduction. Okay.
Absolutely. And then
So
going on to the next question.
thank you.
Absolutely. Someone asked if the charitable donation, it doesn't start until 2026. They just wanted us to confirm.
The charitable donations, does it start in 2025 or does it start in 2026? My understanding, it starts in 2025. But Sierra, if you have the ability to identify who that was, I will make sure I follow up to confirm. But my understanding is the extra $1,000 or $2,000 charitable above the line deduction will be a 2025 write-off.
All right, and then I'm writing their name. Yes, sir. And then going on to the next question, it was regarding the cars and the car slide. So someone asked regarding the senior deduction, is that based on adjusted growth income for the phase out?
It is what's called modified adjusted gross income, and the modification is typically centered around like tax exempt interest and different things like that. Um, but for the most part, it's going to apply to what's called the adjusted gross income. So it's the phase out is going to be centered around what the adjusted gross income is. And then the
Awesome.
modification is they get a chance to add back anything that's considered like tax exempt interest and things like that. There's not a lot of people that have that, but that's the modification part.
Mm. And then continuing with the car slide, someone also asked for a clarification. They said, does the car loan, must it be a brand new car?
Great question. It has to be a brand new car. Yes.
Yeah.
Yeah. The whole spirit of the bill is to spur growth. And so a used car, a new car that's manufactured in final assembly in America kind of speaks to that whole economic growth thing. A used car, you can actually buy that from another individual. So unfortunately, used cars are not part of that. It's new
Mm.
cars.
And a continuation of the car conversation, someone also asked, is there a limit in the year of the vehicle?
Well, if it's a new car, if I'm understanding the question, if there's a limit to the year of the vehicle, if, for example, it has to be a 2025, and because it's a temporary thing, it would have to be a 2025, a 2026, a 2027, or a 2028. So short answer is that's back to the used car thing. You couldn't buy a used car, a 2024, and it count towards this auto interest deduction.
Mm, yes, sir. Give me 1 second. We got some more questions flying up.
I love it. I love it. Thank you guys so much.
All
And
right. So
go ahead, Sam.
right. Yes, this was the most recent question that I saw. Someone said that they had a question about the child tax credit. They
Mhm.
were reading the fine print, and it mentions that it doesn't mention an age. So, would it be implied if the age was not formally listed?
Yeah, if you're talking the child tax credit, yeah, there's no fine print to that. It's the child tax credit has always been for a child that is less than 17. And the only thing this new bill did was increase that $2,000 to 2,200, but it's always been um, for a child. And the IRS's definition of a child is somebody who is 16 years or younger.
Absolutely. Yes, sir. And then someone went back to the car slide. They wanted another clarification. They said, does it matter if it's just AWD or not?
I think that means all-wheel drive. Doesn't
Mm,
matter if it's all-wheel drive or not. I'm pretty sure it doesn't. That's getting into the front-wheel drive or all-wheel drive. That is a particular trim you can request, but it doesn't. It won't affect it. The fundamental nature is it has to be a new car.
absolutely. Other than that, there was a note from one of the attendees that I did copy, Mr. Fred.
Okay.
But other than that, that was the last question.
Okay, and you know, I can see that. And that's Terry. I appreciate you, Terry. Terry's on it. Terry's on it. The charitable deduction big beautiful bill refers to the signed into law, which significantly changes charitable donation rules beginning in the 2026 tax year. Thank you, Terry, because what my research was suggesting was 2025. That's why it's gray out there. But as we get closer to tax filing season, things will get clearer. But my understanding was 2025, but if you're finding something that's 2026, I don't disagree. We'll just have to kind of get some more clarity on that and everything. Awesome. Well, Sierra, if there are, you want to give people a couple more seconds if there's any final questions that people have. If not, then they're going to get themselves 26 minutes back in their life.
Give me 1 second, Mr. Fred. So this was in the chat. There was a question in. Oh, I see. We answered that. We answered that. All right. So let me go back to the chat. Nope. I don't see another one, Mr. Fred.
Perfect. Well, hey, listen, I thank you guys so much for taking the time to listen. I hope it was helpful. Just know as your tax professional, and we did put this out on social media, so there might be some people on the call that are not actually clients of mine. But just know that we as a team, Tammy, Sierra, and I are staying on top of this. So when it's time to get the taxes done, we will be 100% up to speed on how it positively impacts you, or unfortunately, if it negatively impacts you. So we will stay on top of making sure that we are equipped to help you guys out. And I think with that being said, um, thank you guys so much. And I think I see, was this recorded? Sorry, if this was recorded. Yes, it's recorded to the cloud. We'll have to figure out how we can get it to people though. Okay. Thank you guys so much. And I'm always here to help. If you didn't get your question answered and you feel like you want to have a special time with me, call or text Tammy and we can jump on a Zoom or a phone call or something like that. All right. You guys take care and we will see each other and talk to each other soon.